Purchasing properties through a trust has become an increasingly popular consideration for investors because it can offer excellent tax benefits, asset protection, but is it the right structure for you? Hello everyone, Shukri Barbara here from Property Tax Specialists. I'm here to help you navigate the complexities of Australia's property tax regulations. It's a sad reality that many investors don't think about the best ownership structure for their portfolios. While owning your own assets in your own name is an option, you may want to consider a few more of the options out there when it comes to ensuring that your family interests are protected too. Trust structures, especially family trusts, are quite popular when it comes to asset protection, tax benefits, managing family businesses, and your family members' financial interests. But to have a clear understanding of how property investing works within a trust structure, there is a range of key factors to consider. And that's what I'm going to discuss in today's video. But before I run through the pros and cons, you should know that this information is intended to be a guide only, providing an overview of general information available to property buyers and investors. This guide is not intended to be an exhaustive source of information and should not be seen to constitute legal, tax or investment advice. You should, where necessary, seek your own advice for any legal, tax or investment issues raised in your affairs. So, there are actually quite a few different trust structures to choose from. The four most common ones are family trusts, fixed trusts, class trusts, and hybrid trusts. But for the most part, investors tend to steer towards family trust because of their discretionary nature. So, for this video, I'm going to discuss the pros and cons of a family trust for property investing. I'll start with the advantages. The first major advantage is asset protection, as the investment property is held in the trustee's name, not your own. The property is protected from creditors if one of the beneficiaries goes bankrupt or is the subject of legal action. Now, this doesn't mean you should set up a family trust to defeat creditors. That's illegal, and they're right. But essentially, creditors won't be able to use the trust assets to settle any debt you owed if certain conditions are met. Another big pro of a family trust investment structure is the tax benefits. The trustee of a family trust has the flexibility to distribute any income generated from the investment property as they see fit. So, the trustee has the discretion to divide the income between the beneficiaries in the most tax-effective way each financial year. For example, for beneficiaries of the family trust who fall under a lower marginal tax rate, the trustee can distribute and pay more income to them as a method of reducing the overall tax paid. By dividing the income tax allocation, the trustee can effectively minimize the general tax obligation of the group, the members who benefit from the income-generating property owned by the family trust. Also, if the trust holds the investment property for more than 12 months, you can also take advantage of the 50% capital gains discounts. And then lastly, many families use discretionary trusts for estate planning purposes. A family trust structure enables parents to pass on control of the trust to the next generation without triggering capital gains and stamp duty. Essentially, the assets are retained in the trust, and the beneficiaries can continue deriving benefits from the family trust. So, those are the three main advantages. Now, let's consider some of the drawbacks. If your investment property doesn't generate enough income to cover its expenses, including depreciation, then the property will be negatively geared. This means that your property is running at a loss. A key benefit associated with a negatively geared investment property generally is that you can offset the loss against other income that you earn. But if you purchase an investment property through a family trust, You can't subtract these losses from your personal taxable income. It is retained within the trust. The loss will essentially get trapped inside the trust until the trust generates enough income to cover the losses in future years. Another downside of trust structures is that in some states, owning property through a family trust means that your property may not be eligible for the tax-free land threshold. For example, in New South Wales and Victoria, a family trust doesn't qualify for a land tax-free threshold. So you might end up paying a high land tax amount. You'll also need to make sure that you distribute all the trust income amongst the beneficiaries each year, because any undistributed income that stays inside the trust will be taxed at a high marginal tax rate. Another tax disadvantage to keep in mind is that any distributions to minor beneficiaries, meaning under 18 years of age, are taxed at rates of up to 66%, quite prohibitive. So as you can see, no advantage comes without some kind of risk or downside. It's up to you to consult a tax professional like property tax specialists to help decide whether the advantages outweigh the risks concerning your personal circumstances. This way, you'll be in a much better position to make an informed decision about what investment structure will maximize your return, protect your assets, and provide for the most tax-efficient way of managing your investments. If you'd like to discuss any matter relating to structuring your investments, protecting your assets, or arranging your affairs for minimum tax legally, get in touch today. Otherwise, if you found this video helpful, make sure you click on the like button and subscribe to our YouTube channel for more pros and cons of other ownership structures. See you next time.